Don't buy the cheapest thing on the block. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and I'm going to talk today about mistakes that investors make. And these are mistakes that I have made. These are mistakes that I've watched other investors make, and things that you can learn from as a new investor or even a seasoned investor. Say, okay, yep, maybe I'm making these mistakes, or I shouldn't make these mistakes. And there's many more that I'm not going to even cover today, right? There's a lot of minor mistakes, but these are some of the things that I've noticed that when I've done them, not that they've never worked out, but the opposite is like, hey, if I wouldn't have done that, it would have maybe worked quite a bit better. So first one is location. And I always discounted location, and to an extent, I still do, but location's really important. Don't buy the cheapest thing on the block. Now, you can still make money in a bad neighborhood. You can make money in a terrible neighborhood, but it's really hard to do that. And you have to be a very hands-on manager. You have to really understand how to manage in that area, the type of, especially if it's going to be a rental, the type of tenant you're going to get, all that kind of stuff. I think if you're going to invest in a bad area, flip is better. But here's the problem is, and this, I just was talking, this guy yesterday, this happened to them, and they renovated this entire unit, and when they got almost all done, it got broken into and pretty much everything got stripped out and stolen. And I've seen this happen plenty of times. And so it just, is it really worth it? Is it worth the risk of that location if you're investing in a bad area? Now, here's why it's attractive. It's attractive because the prices are cheap. You're going to buy that, house for $20,000 or $50,000 or whatever it is. And hey, man, that's so cheap. Why would I buy the house for $250,000 when I can buy the house for $50,000, right? Just a couple blocks away, 6 blocks away, 12 blocks away, whatever it is, or even a different town. Well, it's because the one property is in a much better location, right? And what I've observed is, as the market goes up, the properties in the good locations go up much quicker percentage-wise than the property in the bad locations. When properties go down, the properties in the bad locations go down much quicker than the good locations percentage-wise. Now, dollar-wise, certainly, but percentage-wise, the nicer houses, the better properties, the better apartment buildings are going to have less issues than the worst. We're seeing it in apartments work out right now, right? C-class apartments are struggling the most. C-class apartments have the highest vacancy rates. C-class apartments are performing the worst. They've got the highest cap rate expansion, everything. And A-class properties are still high demand. Now, in some markets, there's major overbuilding, so those are struggling. But it's actually, it's funny, there was an article that I read, and I didn't fact check it, so maybe it's wrong, but I doubt it. I actually think it's probably pretty much spot on, is that all this building is happening in these markets, and it's actually affecting the C-class apartments more than the A-class. So the saturation is happening in the market. It's oversupplied, but yet A-class apartments are continuing to rent strongly, where C-class is what's getting hurt the most. Now, it didn't say A-class wasn't getting hurt at all. C-class was getting hurt the most. And so I've observed this happen. I was, buying and flipping houses, and I was buying a lot of rental properties in C-class locations, not in the worst neighborhoods, but in, neighborhoods near the worst neighborhoods. And it was good, and I made a lot of money. Don't get me wrong. I did really well, and we, bought them for great prices and rented them and made a lot of really good money. And many of them I've sold since and, made really good money. But what I have seen is if I would have bought in a nicer neighborhood that I was still able to cash flow in, then I would have made a lot more profit on those properties. I would have cash flowed better because I didn't have the issues with the residents. I would have been able to stay full 100% of the time versus I had really good occupancy, but and again, I cash flowed well, but I had a few of the houses where when the tenant moved out, the whole house was destroyed. You know, we we just had some issues. We had more probably evictions than what I would have had if I would have invested in a nicer neighborhood. And so again, I did really well, but when I observe these other areas and I look at some of the other investors that I've talked to, and not even necessarily investors, just a guy or a gal who just bought a house in a different neighborhood, and I say, "Wow, you bought that house for $110,000, yet you sold it for $450,000, right? I bought a house for $40,000 and I sold it for $140,000. Again, still good profit, but not close to what that other person did. I was making, 350 or $450 a month, which was great. They maybe started out making $300 a month, 250 even, $200 a month maybe. But by the time they were done before they sold it, they were making six, seven, 800, and I wasn't, right. And so that was the probably the biggest difference is watching that expansion of their property in that better neighborhood than mine. Okay. And then the last one is I bought a property, an apartment building in a really bad neighborhood. And this was a big mistake, right? I bought this property because it was cheap. I mean, I bought it for a great price, seemingly. It was a 20 units, and I bought it for $180,000, 185, I think it was. So great. We fixed it all up, got a management company in there, and I should have sold it immediately, right? But ended up getting a management company in there. They did okay. I ended up firing them because their bookkeeping wasn't great. I probably should have kept them, quite frankly, because they knew how to manage that type of property. Then I hired another property management company. That was a disaster. The whole property got destroyed by the tenants that were in there, and we had to fully re-renovate everything. Fired them, hired a new company. We're a temporary company just to kind of hold the ground down until I found a new one. I found the new one, hired them, got the thing fully renovated, sold the property. And I renovated twice where I should have renovated once. I could have made a decent amount of money for a lot of hassle, but I didn't. I made a little bit of money for a ton of headache and hassle, a lot of flights down there, just a lot of work. Physically working on the property. There's many stories I could tell about that adventure, but the point is that it was a bad location, and because of the bad location, it just it just struggled. It just struggled. And I should have spent more money on a better location. Yeah, I didn't get it. I wouldn't have got that other location for a song like I did $9,000 a unit in 2015, 2016, somewhere around there. Like that was unheard of, right? But there was a reason it was unheard of, is because that was a terrible neighborhood and I shouldn't have bought that property. All right. So location, and don't be a cheapskate, right? Just buy the better property. You're really going to thank yourself for doing that. Number two is financing. Get good financing and work with a good lender. There's good lenders and there's bad lenders. Get references. Make sure it's a lender that's reputable. Make sure it's usually a lot of people think, and I have made this mistake plenty of times. You think, well, it's a lender. They're professional. They're gonna be good. That's just not true. There's slimy lenders out there. There's terrible people everywhere, and that goes with the lending industry. And so make sure you're working with a good lender that's going to work well with you and understand your business plan is on board with your business plan and is flexible with your business plan. Ask them tough questions, right? Ask them, hey, what happens if, I know the renovation, we're scheduled to complete this in 12 months. What happens if it takes 24 months? What happens if we run into some issues where, our cash flow isn't as strong as what we underwrote, and we need to whatever, delay renovations, or it just, our cash flow is just not as strong, and so it's just, it's going to take, everything takes longer. What happens in those instances? What do you do? And can I get that in writing? You know, email them that question, I would say. So ask them, about the draws and how long it takes and what they're requiring and all that kind of stuff. Make sure you understand who your lender is. Get references, ask for referrals. Who's done these types of loans? Can I get some contacts so I know how they interacted well with you, and what went wrong? And I want to know that. I would rather just work with lenders that are recommended to me, or lenders that I've used in the past that I've had good experiences with. Those are the best. The other thing with the financing is there's short-term financing, there's fixed rate financing, there's floating rate financing, there's all kinds of financing. Understand the risk versus reward with your financing. And real estate and investing in general is all risk versus reward. When we talk about locations, the worst of the location, the higher the risk. The worse the financing, the higher the risk. And when I talk about worse, I'm talking about, floating rate debt, bridge debt, hard money lending. Those are very high risk. Uh, Understand that if you are buying a single family house and you're getting a hard money lender, understand that that's a high risk loan, right? These guys aren't out there to be your best friends, and it's just high risk, and the rate might be floating. Bridge debt is very risky if you're going to be in multifamily, and these are floating rate debt, and it just adds a big layer, potentially unnecessary layer of risk out there. I've talked a lot about this, so go back to prior episodes. So if you can get it, fixed rate debt is the best, of course, and for as long of a term as you can get that makes sense for your business plan, is the best thing to do. Local bank debt, in my opinion, is pretty solid. But again, make sure you understand who the local bank is, how they act in situations where you never intend for things to not go 100% as planned. You're expecting it to go better, right? You're expecting that, hey, I'm trying to be conservative here. I think this renovation is going to take 12 months, and I told you 16 months, right? But what happens if it takes 18 or 24, or even longer? What happens if you go over budget? What happens if, just X, Y, and Z happens? You want to know what that lender is going to act like. So understand that. All right. The number three, poor business plan. If you don't know what you're doing from the outcome, or from the outset, you're not going to get good outcomes. It's just not. And you need to make sure not only that you have a good, solid business plan that's set up, that you have the right people in place, and that you don't set yourself up with this grandiose business plan but not know how to execute it. So it's not only the business plan, but the execution of the business plan, making sure the right people are on the seats, right? Making sure that everything's in order from the start. Some of the things that I've done wrong is we start a project, or we close on a property, and we have nothing in place. We're not ready to go. And so it takes 6 months to get going, or 6 weeks, or whatever. It's like, it should get started. We should be ready to go right away. Dumpsters show up, contractors show up day number one. That's what we want. We want to be ripping cabinets out the first day, or whatever we're doing, right? We want to make sure we have that business plan that's clear, concise, and our whole team understands the vision and what we're doing so we can execute on it quickly. And the next one goes with the business plan. It's poor management. Poor management, not only property management, construction management, management on your part of the property management, of the construction management, of the entire team. That wrecks deals really quickly, especially when we're talking on a heavy value add, on a flip property, something like that, of course. So, I told you already a couple, I've went through managers before, but poor management can really ruin a deal really quickly. We talk a lot about raising money and finding deals and buying the deals and all that kind of stuff, but we talk very little bit about management, property management, asset management, construction management. Probably because they're not quite as fun of topics to talk about, but they're super important. And I've watched management companies. Perfect example. One of the first apartment buildings that I purchased, hired a management company. They had locations nearby, kind of in a town that was about an hour away. They had a lot of locations and seemingly a good management company. They had one location in the market that I was in, and so I thought, okay, that's going to be perfect. I'll add these buildings to their management, and they'll do well. Okay, well, here's the problem. They didn't do well. And why didn't they do well? They didn't train my staff at all. So we kept on going through staff, a lot of turnover. I continued to blame the market and the turnover, the staff, just poor staff. Finally, I had to say, okay, this has got to be a management problem. And so I fired that management company. I hired a new management company, and very quickly that turned over to be an excellent story. And what the biggest difference was the management company, the training they're providing the staff, the support they're providing the staff. This new management company provided the support, provided incentives, provided training, and very quickly we went from not being able to lease out units to being able to lease out units at much higher rent. And so that was obviously excellent, and it was just by hiring the right management. And I've seen it as far as staff on the ground. I've seen it high level. So management is huge for being able to properly execute on your business plan. And then same thing with construction management. Look, I've let the ball drop myself on construction management when I was flipping houses. If I'm not there, things aren't happening. And I watch it every time, quite frankly. Every time if I'm buying a property out of state and I come to the property, things get done quicker when I'm announcing I'm coming. And for several days after I'm there, they get done quicker, and then they'll slow down. And if you're not doing a good job while you're on site and not doing a good job while you're off site, they'll slow down very quickly, and sometimes halt to a complete stop. So got to make sure you're managing everything. This is a big one, not enough cash. And I guess the two of them. Okay. So not low reserves, and then trying to do everything out of your cash flow. Okay. Instead of a renovation budget. So we're going to talk about two different things. So low reserves is just look, whether you're doing a construction project or not, things can happen. And I had, again, perfect example. I had a property where I purchased the property and roof started leaking. We had plumbing issues. We had all kinds of things that happened. And I didn't have nearly enough of a reserve budget. And we burned through our entire reserve budget within the first probably 6, maybe 9 months. We burned through the entire reserve budget. So I had nothing left. And so every other item that came up had to be taken care of out of cash flow. So now the cash flow is struggling because, well, we might be making, $5,000 that month, but if, and so we maybe have, 2 or 3 months in a row, we make 15, maybe it's even, $20,000, right? But all of a sudden, then we have a big repair item that needs to happen, and it eats up all of that money again. Or we want to start doing reserves, or start doing some more renovations, or step them up, and we just don't have the cash, right? We don't have the liquidity because we didn't budget up front enough reserves. So you want to make sure you're budgeting ample reserves. And what you think of as ample reserves, people say, well, how much should I budget? And the general rule is you should be budgeting for, if you're doing a value add property, you should be budgeting about 6 to 9 months, likely more like 9 months. It depends on the age of the property, depends on what you're doing for that value add too. Look, if I'm doing a value add and I'm replacing all the furnaces, I'm replacing the entire HVAC, the entire plumbing system, roofs, and things like that. Well, of course, I can budget a lot less because I am taking care of all the big ticket items already. But if I'm not, and those are aging already, then I might need to budget even 12 months of reserve. So you got to look at what you're budgeting for and then say, okay, where should my reserves be? But look, we're buying a building right now. I'm budgeting for a plum. I've got a plumbing reserve budget that I set aside. I've got an HVAC reserve budget I set aside. I've got a boiler reserve budget I set aside. I've got a roof reserve. Now the roof reserve I'll use, but the other ones I may not use. I've got several other big ticket items that plumbing that we don't know if we're going to use those or not, but we say, look, these are aging items and we want to budget for them. We're going to hold the property for about 5 years. But what happens if we uh, don't replace those and we sell the property in 5 years? Well, we'll get all that money back, right? We'll keep the money. The money's going to go in an interest bearing account. It's going to be in a money market account. We're keeping the money. We're going to even make money on top of it. But the point is, we've got that money set aside because what happens if those things do need to be replaced in the first 5 years that we own it? Well, then we're not digging into cash flow to try to pay for those things. We're not sitting here scrambling going, oh crap, how do we pay for those things? So we're trying to be prepared, and hopefully, we're over prepared. That's great. And sometimes we might have to even rebucket those things because maybe the HVAC doesn't go out, but something else happens that we didn't budget for, that we didn't foresee being a problem. And so now we can reallocate our buckets a little bit, but we have the money set aside. That's the main point of it. And then we have another reserve account on this property. That's just a general reserve account. And again, it's 9 months worth of principal and interest payments that we're setting aside, saying, okay, stuff can happen. And we've got that money set aside for that stuff. And then every single month, we're also putting away more money, and to make sure that if stuff happens that goes bad, we've got plenty of money. And on top of that, the last one is just not budgeting enough for renovations and not being thoughtful enough and try to. There's two things that I see people do, and I've never done this one. So I'm proud that I've never done this one, but I hear people talk about it all the time. Is they're like, well, we're just going to do this. This property cash flows really well, and we'll renovate through our cash flow. That to me is a huge mistake. Don't do that. Don't do that. Set the money aside so you are ready to renovate when you want to renovate. You've got the money there because cash flow doesn't always happen, and especially if you don't have a property well renovated, sometimes cash flow is worse than what you think. It's harder to rent those units, and you're like, man, it would be much easier if I could just renovate these units. Well, yeah, it would. So you should have had the money set aside up front. So set the money set the money up front for that, and make sure you have enough. And that's really easy to try to skimp on your budget. Look, I used to be able to renovate an entire unit, and this is not that long ago. 2019, I could renovate an entire unit for $8,000 to $10,000. Okay, $8,000 to $10,000. I could get an entire unit done, looking really good. Maybe up to 12, depending on exactly what we're doing. Okay, today that same renovation, that $8,000 to $10,000 renovation today is costing me about $20,000. Okay, prices have gone drastically in a matter of 5 years, 6 years. prices have skyrocketed. So what used to cost me 8 to 10 grand is costing me close to $20,000 today. And sometimes more. Again, like the more I got to do, it's just crazy how much more it's going to cost me. So don't skimp on your budget. It's really easy to think about those times where units were cheap and think you're going to continue to do those and just totally hose yourself on your budget. So make sure you've got a large enough budget with large enough reserves on that budget with large enough contingency and saying, well, what happens if we dig into a unit and there's mold or whatever? So set plenty of money aside for that. All right. So that's all the mistakes. There's plenty of more. Certainly, it's tons of mistakes that I've made, but top mistakes are location, buying cheap locations, financing, poor lender, poor business plan, poor management, low reserves, and renovations, out of cash flow or low renovation budget. So those are the things to look out for. If you really are minding your business properly and avoiding these mistakes, those mistakes that I talked about, you're going to have a lot better chance of success. Of course, there's still higher risk, items if you're not doing things right, but those are going to help you be successful. So hopefully that helps. I'm Todd Dexheimer signing off. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.